Well, for more on the Federal Reserve's decision, I'm joined by William Lee, Chief Economist at the Milken Institute. Good to have you back.
Thanks, Rachelle.
So what would you say are the biggest headlines coming out from the Fed news conference?
I think Chair Powell wanted to reassure the markets that they were there to back the economy. They're not going to be raising rates or tapering anytime soon. And the main message is they're not going to do anything until they see the economy actually return to where it was before, and even in a better spot, because he also reminded everyone that the Fed has an expanded mandate now, which is not just maximum employment, but maximum inclusive employment to try to address the inequalities and the lack of participation that many members of our society have had in past recoveries.
So given that, then, break down the Fed officials' impressions of the U.S. economic rebound and their main concerns.
I think the Fed has got the message that the economy itself is coming back very strongly because of the vaccine successful rollout, and also the consumer side of the economy seems to be well in hand. People have a lot of savings, those who are working. Those who are not working have gotten transfers from the government so that they also have income to not only sustain themselves, but enough to support the initial opening up of the economy. The dangers that they were warning about was the bottleneck inflation, the kind of price increases that come about because everyone rushes out to buy the same thing at the same time. And that's something that the Fed chair emphasized very strongly, which is to say, we're going to have higher prices for quite a few months. And in those quite a few months, the markets should not panic, and the markets should continue to go on as normal.
Because as we did see it there from John's report, markets a little bit concerned that they're keeping the rates too low for too long. But he did say he didn't want to just base it on one report or one forecast. So under what conditions do you think the Fed would raise interest rates?
We have a very new regime now here at the Fed. When I used to be at the Fed, the onus was on the economists like me to get a forecast that was accurate and robust because policy was going to act on the forecast. Now I think it's to the chagrin of most economists out there, and maybe a statement about our poor forecasting track record. The officials of the FOMC said, we're not going to rely on forecasts anymore. We're not going to rely on models anymore. We have to see the data actually show the economy recover and prices start to return to that 2% inflation path and to sustain it for a long period of time. More importantly, the chair emphasized that they were looking at inflation expectations, and they wanted to make sure that inflation expectations rose to the 2% level from the below 2% level that they were for the last several years.
And as he did say, really the priority is focusing on containing and improving after the pandemic. So how important are vaccination rates to improving other economic data points?
Oh, the chair said that that was part and parcel of the recovery. In fact, he said he had a hard time understanding a situation where you would have a recovery and not have a fully effective program of vaccinating the people so that there would be protection against the spread of the virus. After all, remember, it was the virus itself that caused the economy to shut down. This shutdown was not anything related to economics or anything wrong with the underlying economy. It was shut down because the health authorities decided it was not safe to continue as usual. And the health authorities are also saying we're not going to fully open until we feel it's safe. And that is fully a function of what the vaccines are doing.
And as we're seeing, though, jobs are starting to come back. So how will we know when we've reached full employment? And when do you see the labor market returning to that level?
That is the great question, Rachelle, because as I said, the Fed has expanded its mandate. It used to be that full employment was a number, whether it's 4% or 3.5%, a number on the unemployment rate. Now, the Fed chair has made it very clear that he's concerned about the quality of the employment gains and the breadth of the employment gains. He wants to make sure that the minorities and people who were left out in previous recoveries also were able to find jobs. So we're going to find the economy running quite a bit hotter than usual because he wants to expand the employment base to include those who have never been included before.
So then as they look ahead to their overall U.S. economic outlook for 2021, how much has that improved from the last Fed meeting?
Oh, the economy itself has improved tremendously. I think all of the data show that the employment gains as well as the production gains and the amount of consumption that's gone on, the retail sales numbers have really accelerated tremendously. As I said before, that's partly because of the economic support from the fiscal packages and also the monetary and financial condition support that the Fed supplied.
Now, obviously, as we know, the US is doing better in terms of its vaccinations and everything else, and is starting to see a recovery. We're also seeing that in China as well. What do you see as the biggest global risks, though, to the US economy?
I think the biggest risk is the unevenness of the vaccine rollout. That was, in fact, that's pointed out at the IMF forecast at the last meetings, that they feared most, and the biggest risk to the global economy was the inability to roll out vaccines in a fast manner across the countries in Europe as well as the emerging markets. The tragedy that's beset India right now is a good example of what happens when vaccines are not given out quickly, and more importantly, when vaccines are not accepted by the population as a device with which they could protect themselves.